Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at applied optoelectronics, or AAOI.
If you find our talks useful, please consider subscribe, like, and comment underneath, and check out the 14-day trial link for StockOracle in the description. Just a quick reminder, as an affiliate, we may earn a commission if you use the link, and also, our AI insights and value estimates may be wrong and should always be verified. We're here to talk long-term wealth building, not short-term trading.
Exactly. And today's deep dive is just one of the most fascinating friction points in the market right now. You have fundamentally historic, accelerating business performance colliding head-on with a stock chart that looks like it's in a total tailspin.
Right, because there's this company sitting dead center in the middle of the biggest technological infrastructure build-out in human history. I mean, they are manufacturing the physical key to the global AI boom.
Yeah, they really are.
Their quarterly revenue just exploded by 86% year over year. Cash is absolutely flooding their balance sheet. And yet, if you pull up their stock chart over the last 13 weeks, the share price has collapsed by almost 30%. So today, we are figuring out why.
To understand that massive disconnect, between an 86% revenue jump and a 30% stock drop, you really have to look closely at the awkward, incredibly expensive adolescent phase of a hardware business.
Yeah, it's painful to watch sometimes.
It is. It's the transition a company makes from being a speculative growth story to a fully scaled, high-volume manufacturer. And as the numbers in our research show, that transition requires an astonishing amount of upfront capital.
Right, and as someone who always looks at protecting capital first, that transition makes me incredibly cautious. Because if they're completely bottlenecked by factory size, the only way out is to build more factories, which is, risky. But before we get to the confusing reality of their balance sheet, we need to understand the physical product that is actually flying off the shelves.
Which is the exact component causing supply chain nightmares for tech giants globally. They make 800G and 1.6T optical transceivers.
Right.
So think about an AI compute cluster. You have tens of thousands of GPUs, right? The servers doing all the heavy computational lifting. And they have to share mountains of data with each other in fractions of a second to train these models. The optical transceiver is the physical translator.
Like the central nervous system of the AI data center.
Exactly. It takes the electrical signals from the computer chips, converts them into pulses of microscopic light, shoots that light across fiber optic cables, and then translates it back into electrical data on the other side.
And the speeds we're talking about are difficult to even conceptualize.
Oh, totally.
Like 1.6 terabits per second per connection. The hyperscalers, the Amazons, Googles, and Microsofts building these facilities, they're demanding these specific high-speed components faster than the global supply chain can physically assemble them.
Yeah, the research notes that demand from these hyperscalers is vastly exceeding their production capacity all the way through mid-2027. So they're entirely supply constrained.
Wow. All the way to 2027.
Yeah. It is not a matter of finding buyers. I mean, it's literally a matter of physically pushing product out the loading dock fast enough. And on top of that, there's a severe structural shortage globally of the AI laser chips that actually go inside these transceivers.
Right. I look at the situation like trying to push a fire hose of water through a garden hose nozzle. The GPUs are the fire hose, generating just unprecedented amounts of data.
Yeah.
The transceivers are the nozzle.
That's a great way to picture it.
Yeah, and if the nozzle is too small, or if you just don't have enough nozzles, the entire multi-billion-dollar data center backs up. The GPUs sit idle. But here's the twist with this company, and this is where I get a bit hung up. They are vertically integrated.
Right. They don't just assemble them.
Exactly. They manufacture the raw laser chips themselves. So let's unpack this for a second. If they control the absolute bottleneck component in a global shortage, shouldn't they just have total pricing power and dictate terms to the market?
You would think so, right? But what's fascinating here is that while vertical integration theoretically insulates their gross margins, which are currently sitting at a very healthy 28.9%, by the way, the fundamental limit on their revenue isn't pricing power.
It's physical reality.
Yes, the limit is throughput. It requires highly specialized clean rooms, nanometer-level alignment tools, and incredibly rare engineering talent to manufacture these lasers and assemble 1.6T transceivers at scale.
It's not just stamping out plastic parts.
Not at all. You can have all the pricing power imaginable, but if your factory physics only allow for a set number of units per month, your top-line revenue hits a concrete ceiling.
which perfectly explains the bizarre contradictions in their financials, because the revenue acceleration is undeniable.
Oh, absolutely undeniable.
In the first half of 2026, they hit $343 million, up roughly 69% year over year. Q2 alone brought in nearly $192 million, and their balance sheet has completely mutated to support this operation.
Mutated is the right word.
Yeah, like in late 2025, they had about $206 million in cash. By June of 2026, that cash pile surged to nearly $500 million. Their total assets essentially doubled in 6 months, going from $1.1 billion to $2.3 billion.
And just notice how capital-intensive that scaling process is. Doubling your asset base in half a year means aggressive, nonstop expansion of physical infrastructure.
Right, but here's where it gets really interesting, and honestly where my valuation alarm bells start ringing. The report highlights that they hit non-GAAP profitability in Q2 2026.
Which is great news on the surface.
On the surface, yeah, their core operations are making money, yet their GAAP net losses actually widened to $37 million for the half year. If you were selling everything you can possibly manufacture and revenue is jumping 86% in a quarter, why are they losing more money on paper?
It comes down to capital expenditure, or CapEx. They are burning through cash to aggressively expand their factory lines, aiming to produce 930,000 units per month by the end of 2027.
Almost 1 million of these hyper-advanced optical components every single month.
Exactly.
Yeah.
To build the infrastructure capable of that volume, you're buying land, laying down pristine clean rooms, and purchasing lithography and alignment equipment that costs tens of millions of dollars per machine. So while the core business of making and selling the transceivers is structurally profitable, the sheer weight of the investment to expand capacity is dragging their official bottom line deep into the red.
And as an investor focused on sustainable wealth building, I look at how they're paying for that. They can't be funding a massive physical expansion like this with traditional debt, not with where interest rates have been and the inherent risk of hardware manufacturing.
No, they have to be hitting the equity markets.
Right. They are utilizing a $600 million at the market, or ATM, equity program.
So they're continually creating new shares and selling them directly into the open market to raise that cash.
Which explains the $500 million cash pile.
Yes.
They are essentially selling off pieces of the company, heavily diluting existing shareholders, just to pay the construction crews.
And that acts as a constant ceiling on the stock price. The market sees the 86% revenue growth, it gets excited, but every time the stock runs up, the company is highly incentivized to hit the bid, sell more shares through the ATM, and fund the next factory line.
Because they have to.
Right. Existing shareholders are absorbing massive dilution to keep the lights on. It is a necessary mechanism to survive a hyper-growth phase in hardware, but it is a brutal environment for a retail investor's portfolio.
Extremely brutal. So the company is locked in this intense, cash-burning sprint to meet current AI demand. But there is a massive external catalyst brewing in Washington that the report highlights, one that could completely reshape their addressable market.
The regulatory wildcard.
Yeah, we are talking about potential FCC bans on Chinese optical components. Regardless of the politics behind it, we just have to look at the market mechanics. This company has a significant footprint of US-based manufacturing.
Right. And if we connect this to the bigger picture, in critical tech infrastructure right now, regulatory geography is becoming just as important as engineering specifications.
Wow, yeah.
The major hyperscalers are hyper-aware of the supply chain vulnerabilities tied to overseas manufacturing. If the FCC restricts Chinese optical hardware from U.S. data centers, those tech giants have to urgently pivot to domestic suppliers to maintain their build-out schedules.
Okay, but let me push back here. If they are already completely supply constrained, if they have a backlog stretching to mid-2027 and physically cannot produce another unit today, how does a regulatory ban actually change their financial math in the near term? Aren't they already selling everything they can make?
Well, it doesn't change their immediate volume, right? But it changes the quality and durability of their revenue.
Oh, I see.
The hyperscalers sign long-term, multi-year supply agreements. If a ban forces a major player like Microsoft or Google to rip and replace their existing supply chains, this company becomes one of the few domestic options capable of absorbing that future demand. It radically alters who they're selling to, which leads us directly to one of the biggest structural weaknesses in this equity report.
The customer concentration.
Yes.
This is the metric that really highlights the fragility of their current setup. The top 10 customers make up 99% of their revenue.
It's wild.
And a single cable TV, or CATV, customer accounts for an astonishing 42% of their entire revenue stream.
Having a legacy cable television provider as your primary revenue engine while you're trying to pivot into a high-margin AI infrastructure is a massive structural risk.
It's terrifying from a capital preservation standpoint. It's like running a wildly hyped restaurant with a line of people wrapped around the building.
Okay.
But inside, 42% of your daily revenue comes from one single guy sitting in the corner booth eating every single meal there.
Right.
If that guy decides to move to a different city tomorrow, your restaurant collapses completely, regardless of how long the line is outside. If this CATV customer pauses their upgrade cycle, the revenue gets cut in half instantly.
Which is exactly why the potential FCC ban is such a massive catalyst. It allows them to transition away from that reliance on legacy cable providers and replace them with the most deep-pocketed tech giants on Earth.
Displace the competitors and upgrade the customer base.
Exactly. But until that transition actually happens, the market is pricing in the terrifying reality of that 42% concentration. This is why the stock carries a beta of nearly 4, specifically 3.85.
So the extreme volatility is just baked in. If the broader market dips, a stock with a beta near 4 is going to experience a violent sell-off. You combine that immense customer concentration risk with the constant dilution from the ATM program, and that 30% drop over 13 weeks starts to look completely rational.
Yeah, the math makes sense when you put it all together.
But the research points to one more glaring red flag that we have to talk about, and that's insider sentiment.
Yeah, this one is tough. Over the period tracked in the report, there have been 0 open market purchases by insiders. None.
0.
Meanwhile, there have been 17 open market sales, totaling over 327,000 shares. The minor sentiment point ratio, the MSPR, is sitting at a -100. That is unanimous selling by the people who know the internal factory metrics better than anyone.
Now, we do have to contextualize this a bit, to be fair. Before this recent 30% pullback, the stock went on an absolute tear. It had a 436% one-year stock run. The executives watched their equity value explode, so naturally they're going to monetize some of those gains. It's not inherently evil.
No, monetizing gains is standard. But unanimous selling with 0 insider buys, at the exact same moment the company is asking the public markets to absorb hundreds of millions of dollars in new shares through the ATM program, it sends a chilling psychological signal to institutional investors.
Yeah, you buy my shares while I sell mine.
Exactly. It raises immediate questions about management's confidence in the short-term upside. Furthermore, this internal selling occurred right as a peer company in the optical space, Fabrinet, missed their profit margins. That miss triggered a sector-wide panic regarding the true profitability of these AI hardware contracts.
Oh, so they just got caught in the undertow.
They got caught right in the crossfire of that narrative, dropping 7% in a single trading session.
So you have a tech spec set up for extreme market anxiety. Management is diluting the stock to build a massive factory. A single legacy customer holds almost half your fate in their hands. The entire optical sector is jittery about profit margins. And the executives are quietly heading for the exits. I mean, the bear case practically writes itself.
It does, but you know me, I'm thesis-driven and I always look at the growth optionality. The bear case is only half the equation. You have to weigh those massive execution risks against the structural AI tailwinds. Because if they successfully navigate this capital-intensive minefield, the financial upside is staggering.
Okay, let's look at that. Let's look at the 3 to 5 year blue sky scenario. Assuming they manage the dilution and actually get these factories fully online, what does ultimate success look like for them over the next few years? And just to be clear for the listener, this is an optimistic scenario, not a prediction.
Right. Strictly optimistic. The blue sky execution revolves entirely around hitting that production target of 930,000 units a month by the end of 2027. If they can physically output that volume, management is targeting $1.1 billion in revenue for 2026.
Wow.
The analysis then points to referenced 170% year-over-year revenue growth heading into 2027.
107% growth on a base of over $1 billion.
Yeah.
For a physical manufacturing company dealing in concrete, steel, and silicon, that is an astronomical trajectory.
It is. And the crucial inflection point we are looking for in this catalyst roadmap is the transition from this current heavy investment phase where free cash flow is deeply negative to fund construction to what we call the harvest phase.
Right. The harvest phase is when the clean rooms are built, the specialized lithography machines are paid off, and the factories are just cranking out 1.6T transceivers at scale.
Exactly.
Your CapEx drops down to just standard maintenance, and the cash finally starts piling up in the bank instead of going straight out the door to contractors.
And that transition triggers a fundamental market re-rating. Right now, Wall Street values them as a speculative, high-risk, cash-burning growth story. The moment they enter the harvest phase, they get re-rated as a highly profitable, self-funding infrastructure player with a deep moat around U.S. manufacturing. That completely changes the multiple investors are willing to pay for the stock.
So if you are tracking this industry and trying to build long-term wealth, it is very easy to get lost in the noise of geopolitical rumors and insider selling ratios. What is the specific near-term metric on the balance sheet that actually validates this blue sky thesis moving forward?
The true compass for this stock will be the upcoming Q3 2026 earnings report. Specifically, you want to watch the relationship between their operating cash flow and their capital expenditures. The market already knows they have the demand to grow top-line revenue. The catalyst is proving that their revenue scaling is finally outpacing their need for incremental capital investment.
They have to prove the business can actually self-fund the expansion.
Exactly. Once they demonstrate they're generating enough cash internally to fund their operations and factory buildouts, they can shut down that $600 million ATM dilution program.
That would be huge.
Huge. The moment the threat of constant dilution is removed and the gap losses rapidly narrow toward profitability, the entire narrative flips. The stock shifts from being a liability that constantly needs fresh capital to a cash-generating asset capturing the most lucrative AI infrastructure contracts in the world.
It really changes the entire perspective on the AI revolution. We are so conditioned to view this boom as a purely digital phenomenon.
Oh, for sure.
We think about software developers, code generation, and massive cloud algorithms. But the core lesson from analyzing a hardware manufacturer like this is that in any massive technological leap, the most brutal, high-stakes battles are fought in the physical bottlenecks.
Because the physical constraints of reality simply do not care about a software developer's aggressive timeline. If the hardware isn't there, the code cannot run.
It's the optical transceivers linking the servers, the microscopic laser chips inside those transceivers, the copper cooling pipes managing the heat, the massive upgrades to the local energy grid. Understanding a company like this trains you to look for the physical picks and shovels of a technological boom.
Right, the real foundation.
But it also makes you hyper-aware of the punishing, capital-intensive costs required to scale physical manufacturing. It is incredibly expensive to build the future, and investors often underestimate the dilution required to get there.
Navigating that volatile transition from building the factory to harvesting the profits is where generational fortunes in the hardware sector are ultimately won or lost.
Absolutely. So, to bring it all together for our wealth-building verdict today, the strongest long-term driver here is clearly their vertical integration and the massive structural demand for 1.6T transceivers as AI data centers scale up.
Yep.
Their biggest threat is the sheer cost of scaling physical manufacturing and the constant shareholder dilution required to fund it, plus that terrifying 42% reliance on a single legacy cable customer.
Right. The base case is that they muddle through, dilute heavily, and eventually transition their customer base over the next couple of years as the FCC bans potentially kick in.
And the blue sky case, again, optimistic, is that they hit that 930,000 unit per month target, shut down the ATM program, and become a self-funding, high-margin domestic infrastructure powerhouse generating over $1 billion in revenue. Overall, it's a high-risk, high-reward infrastructure play that requires incredibly careful monitoring of their CapEx and cash flow.
Perfectly summarized.
But I want to leave you with a final thought to mull over as you watch this sector evolve. They're currently betting their entire financial future, right, spending hundreds of millions of dollars and heavily diluting existing shareholders to build out massive factories absolutely dedicated to producing 800G and 1.6T optical transceivers.
They are all in.
They are fighting a brutal war to build the ultimate toll booth for the current generation of AI data centers.
A toll booth that currently requires a $600 million ATM program just to pour the concrete.
Exactly. But we know how incredibly fast the world of computing architecture is moving. The pace of innovation at the hyperscaler level is blinding. So here is the provocative question. What happens if, 2 or 3 years from now, As these massive factories finally come fully online, the next generation of quantum computing, or some sudden breakthrough in direct photonic computing, requires a fundamentally different physical architecture.
Oh, well, yeah.
Is it possible to win the punishing race to build the ultimate, highly specialized manufacturing plant, only to wake up and find out the tech industry just decided to invent a completely different method for transmitting data?
That is the ultimate existential risk in hardware.
It really is. Well, that wraps up today's deep dive on Smart Wealth with Joshua. Don't forget to check out the Stock Oracle 14-day trial link in the description if you want to dig deeper into the data yourself. Thanks for joining us, and we'll see you next time.